My next guest says that this deal could lead to even more exchange takeovers. Are there any left? Al Berkeley is the former president and vice chairman of the NASDAQ. He is currently the chairman of Pipeline Financial Group. Al Berkeley, good to have you with us on Bloomberg.
Glad to be here, Pimm.
So are there any exchanges that haven't figured out a way to hook up either across the world or around the block? I mean, it seems as though you've got more and more deals being made. Singapore, Australia, Nordic countries, and NASDAQ. What's left? Well, Toronto, London?
Yeah, what you're seeing is a transition from essentially national markets to global markets. And companies in the exchange business need to position themselves to be global companies because capital flows are now global and capital raising is a global endeavor. Are there other mergers to be made? Sure. You're looking at different orbits. The normal pattern that you see in any mature industry is a very significant dominant market share provider, followed by another provider that's about half their size, followed by another provider that's about half their size. That's what we had as national markets were dominant in automobiles. General Motors had about 60%, Ford about 30%, Chrysler about 15%. So this pattern you see in industry after industry. What's important for Americans is to realize we need a piece of that global market. It would have been a far different puzzle if Deutsche Boerse had hooked up with London.
Well, $9.5 billion for NYSE Euronext. I mean, if you're an investor in NYSE Euronext, you're feeling pretty good. And I wonder what the future would have looked like without teaming up with somebody else, because more and more of the business, more and more of the trading, it's done away from the exchange floor anyway.
Well, that's true. If you look at the basic revenue streams that we have in the United States for exchanges, you have listings income, where they charge companies for the regulatory oversight that they provide and the discipline in trading. Secondly, they sell market data, the quotes. Thirdly, they charge transaction fees for transactions among broker-dealers. Remember, the customers of exchanges are broker-dealers. Overseas, particularly in Germany, you have a fourth revenue stream that we don't have here, which is clearing and settlement, which is owned by the exchanges. It doesn't have to be owned by the exchanges, but it happens to be. In the United States, we have that owned by a mutual company, depository trust company, and that serves all of the exchanges and all of the banks.
So do you think this is a good deal, though, that NYSE Euronext finally gets to hook up with someone big overseas? They get to expand the derivatives business. I mean, this seems like a win situation for NYSE Euronext. They kind of escape because this is a technology game. You need money to grow.
Well, I think you're onto an interesting theme. This is a very smart move, and I think that Duncan Niederauer is right on the money in getting this done.
All right. Well, Al Berkeley, for those that don't understand exactly how the exchange business works, why do you need an exchange at all?
Well, exchanges are really artifacts of earlier periods and were awarded legal monopolies. They were run as utilities when they were nonprofits, and the merger and acquisition efforts didn't start until they became for-profits and had their own growth imperative. What you had was a monopoly to trade, a monopoly to list, and a monopoly to sell market data, quotes. And those monopolies have eroded at different paces based on national regulatory policy and based on technology and competition. The monopoly in trading is essentially eroded. You can trade in many different venues on any listed stocks because in the United States we have a rule called unlisted trading privileges, which allows any licensed venue to trade any exchange's stocks. In quotes, you now have competition in the sense that the person who develops the quote gets a share of the quote revenues, so your market share depends on how much market data revenue you get. And on listings, it's basically an oligopoly in the United States between the NASDAQ and the New York.
So right now, is it looking to you as if this deal saved the shareholders of NYSE Euronext? Because what kind of special sauce or technology do they really bring to the table? And maybe even back up and tell us about the NYSE deal to combine with Euronext, because that also is viewed as being very positive at the time.
Well, I think you have to realize that the New York Stock Exchange has very savvy management now, but they failed to invest in technology and modernization from the early mid-90s to the, say, 1995 to 2005. And they're really paid the price in loss of market share because they didn't get their costs down and they held on to some antiquated ways of doing things a little too long, milking the situation.
Like having a floor, for example.
Well, having a manual market, which is what the floor is all about. And now in equities, for example, each instrument has had a different pace of becoming electronic, but equities are essentially all electronic now. And you have companies like my own, which have developed as ways of finding liquidity no matter where it is in the numerous trading venues that have emerged under the regulatory regime we have that has exchanges at the top with the most regulation, the most costs, and the most responsibilities, then electronic communication networks and alternative trading systems, which are essentially broker-dealers with specialized licenses, and below that, broker-dealers who can cross their own customers' trades. Each layer has less regulation as you go down, less cost, and that cost manifests itself in the prices of commissions, which are essentially nothing to trade now.
So where is the profit right now in the business? Is it in specialized derivatives trading?
Well, you see a lot of movement towards the less efficient securities like derivatives, like options. They have their own competitive dynamics. It really depends on how information intense that product is. The more information intense it is, the more you need to know about what you're doing, the less price pressure there is.
What about the floor of the exchange? We heard from Duncan Niederauer, the chief executive of NYSE Euronext, in addition to New York Senator Chuck Schumer coming out and saying that, no, the floor is going to stay, the floor is a good thing. Is it really just a picture? I mean, does anything really get done on the floor? How much business is actually conducted there?
Well, I don't think a whole lot of equity business is conducted there, but you do have options business, and you will have derivatives business. A lot of it came over from the Amex, right? I understand that's true, yes. And so what does the picture of the floor tell you now? Well, I think that the economics of the business are driven by automation. So the floor is, as you said, a valuable symbol, an important symbol. We do need a primary market. In other words, we need IPOs. We need the discipline that exchanges bring in terms of listings, the listing requirements that they have, the enforcement of those requirements. Very important for capital formation, very important for job formation. What we've been talking about so far today is the secondary market. After that stock is listed, where does it trade? It can trade in 30 or 40 or 50 different places. Can you imagine a scenario where the interests of the people in Frankfurt at Deutsche Boerse are slightly different than the interests of those operating in New York in the United States? Well, you're still going to have a regulatory regulation based on sovereignty. So you'll have a different set of rules in Germany, but these are global enterprises, and the market is increasingly global. And I would say it's extremely important for us to have a piece of this very large global market and not have been left out in a mergers chess game where we could have been left out. It could have been acquisition of other exchanges by Deutsche Boerse that would have made it very difficult for us to compete on a market share basis 10 years from now or 15 years from now. So this is a very shrewd move on the part of the New York. What about the liquidity that exists in the market? I mean, you've seen volumes decline. Is liquidity an issue? Well, liquidity is always an issue for most stocks. When I was at NASDAQ, and again, this is 10 years ago, 50 stocks accounted for about half the liquidity in the market, the trading volume in the market. The same was true of the New York Stock Exchange. What we need is good information about the smaller securities that are creating jobs. The compression of research, the information available about securities has been extreme since the regulatory wave after the dot-com bust. All right, I want to thank you very much, as always, Al Berkeley, coming to us as the head of Pipeline Financial Group, sharing your thoughts and insights into how the market works. Thank you very much.